Hey everyone, this week I'm going to focus on how recently enacted policies will bolster the performance of commercial real estate over the coming years. When you get down to it, forecasting commercial real estate fundamentally boils down to basic economics, supply and demand. Of course, there are a lot of nuances when you drill down, but if the macro supply and demand forces are favorable, it's a tide that can pretty much lift all boats. And many of the new policies will have a significant impact on the new supply of commercial real estate. A year ago, the pace of construction for most property types was already beginning to slow down. The cost of construction financing was elevated, and for some property types like multifamily and industrial, key markets were already hitting a new development saturation point. But over the course of the last 6 months, two policies have specifically aligned to further restrain commercial real estate development. The first policy, of course, is tariffs. Currently, factoring in the announced 30% tariffs on the EU and Mexico, the net effective tariff rate is about 20%. So that means a lot of the materials needed to build commercial real estate properties are going to cost more. Beginning in March of this year, the tariff on steel and aluminum was raised to 25%. Then they were pushed to 50% in early June. Roughly 25% of the steel and nearly 57% of the aluminum used in the US comes from imports. In addition, effective August 1st, a 50% tariff will be placed on copper. In 2024, imports accounted for about 51% of the total copper supply in the US. So basically, the cost of construction materials, things like steel I-beams, copper wiring, aluminum wall framing, self-storage doors and partitions, and so on, will all go up in price. In addition, the administration is evaluating a tariff increase on Canadian lumber that would move the rate from about 15% to 27% or more. About 24% of the softwood lumber used in the US is imported from Canada, and the increased tariff would likely weigh on garden-style multifamily construction. Overall, the Producer Price Index, which tracks construction materials, is up about 4.3% so far this year, and many of the tariffs on construction materials have yet to flow through to the market. So basically, the tariffs will make all types of commercial real estate construction more expensive. The second policy that will increase construction costs is the more stringent enforcement of immigration policy. About 34% of construction workers are foreign-born. Basically, they're immigrants to the United States. I've heard unofficial numbers from a variety of builders that suggest the actual percentage may be much higher than that when undocumented workers are included. Specific construction jobs that are particularly reliant on immigration labor include painting, roofing, hanging drywall, and the installation of flooring. So more stringent immigration enforcement and the potential chilling effect that will have on legal immigration to the United States will tighten the construction labor pool. That could increase labor costs and further restrain commercial real estate development. Since 2020, construction labor costs have increased by 27% to nearly $40 per hour, and these costs will likely increase further under the new policies. So between the higher material costs and the higher labor costs, building commercial real estate is becoming much more expensive, and the cost will likely continue to rise. And that suggests new supply additions of all types of commercial real estate will slow in the coming years. That trend was already taking place. Apartment starts are down 77% from their peak in 2022, and the units under construction are down by 51% from their peak. Retail construction has been minimal for the past decade, with just 28 million square feet expected to come online this year, and construction spending on retail projects is down nearly 28% since the third quarter of 2023. Office construction is expected to total about 54 million square feet this year, with the majority of that being built to suit. And we're also seeing a slowdown in the pace of industrial construction, with about 250 million square feet expected to come online this year, and industrial construction spending is down 35% from mid-year 2023. But going forward, the pace of construction will likely slow even further, and the limited new supply will fall short of demand, resulting in tightening vacancy rates and increased rent growth pressure. And that trend is a major opportunity for investors who keep their eyes on the horizon.